Hello and good morning or good afternoon, depending on where you're joining us from today. Welcome to the global release of GP Bullhound's annual Technology Predictions Report. I'm Alec Dafferner, partner and head of the San Francisco office of GP Bullhound, and I'll be hosting today's webinar. Today, we'll look at the top 10 trends that we believe will shape the technology landscape over the coming year. The written report will be released publicly just after this session today. A few housekeeping items. As always, really like to hear from you. So if you have any questions during the presentation, please type them into the question box in the bottom of Zoom. We'll address Q&A at the end of the presentation. We won't take more than an hour of your time today. The webinar will also be recorded, and we'll send you the link to the recording within the next few days. I'm joined today by Per Roman, a GP Bullhound co-founder and managing partner, as well as my San Francisco-based colleagues, Brandon Overmyer and Eric Crowley. So let's get started. For those that aren't as familiar with GP Bullhound, we have a few slides that we'll run you through. The firm was founded in 1999. We celebrated our 20-year anniversary last year. We've done almost 550 transactions over that time period. We have 10 offices across Europe, the US, and Asia, and roughly 100 plus employees spread across those geographies. The firm has delivered over $20 billion in transaction value to clients, and we have over 400 million in assets under management through our funds. On the next slide, you can see some of the key sectors that we focus on within the tech landscape. So software, digital services, fintech, digital media, and online marketplaces and e-commerce. Slide 5 highlights some of the completed transactions in 2020 for the firm. It includes both our advisory business and our investments. I won't go through all of them, but thought I'd highlight a few that are the most relevant to the trends predictions that we're going to discuss today. In the corporate social responsibility area, we've seen a lot of investor interest in Q1. We advised EcoVadis on a $200 million investment from CVC Growth Partners. In the e-commerce area, we've seen a massive acceleration due to COVID. This summer, we advised Orca Pacific, a leading full-service Amazon agency, on their sale to S4 Capital. In the consumer subscription and connected fitness area, we advised 7Next on a majority investment by Oakley Capital. And in the customer experience software space, we advised Talkwalker on their acquisition of Nielsen's social division. On the investment side, in e-learning, we invested in Busuu, a subscription-based online language learning app. And with that, maybe flip to the next slide, and you can see that you can download the Tech Predictions report by scanning the QR code here, or you can go to gpbullhound.com insights and register there. So with that, I would now like to welcome Per Roman, a GP Bullhound co-founder and managing partner, to share some thoughts and comments on the state of tech. Over to you, Per.
Hey, Alec. Well, thanks a lot for that. Well, it's sure been a transformational year in so many ways. I mean, I would summarize and say, first in March, we had what I would call the big buy, probably the greatest buying opportunity in tech in all history. And then followed in Q2 and Q3 with what I would call the digital leapfrog, where suddenly our technologies were adopted en masse, not just among technology lovers and leaders, but also in previously resistant areas like the educational system, government, and consumers worldwide of any age or walk of life. And I think truly we are at a new phase and a new dawn for our industry now, the by far most economically powerful of any industries on the planet. And then I think in the last few months, I would say the emergence of the super IPO, where, so to speak, valuation no longer matters, at least to the stock market in the short term. I mean, good examples of that are DoorDash at $49 billion, Snowflake at $87 billion, Airbnb at 76, and our own investment and portfolio company Unity at 39 billion. Just astounding valuations for still moderately sized businesses. And it doesn't stop there. We've also seen the emergence of the super stocks. I would highlight Zoom at 115 billion for delivering this conferencing service that we're now on. Imagine if Niklas Zennström would have thought about that when he sold Skype. Or Shopify at 130 billion, as we see social internet turn into e-commerce and challenging Amazon and Alibaba. And then maybe most extraordinary of all, the low volume car manufacturer Tesla, now at $605 billion valuation, but of course with a huge head start in electrification. So very interesting to see how that pans out in days and years to come. Finally, in forms of what we see in our industry, it was only a year or so ago that we talked about the possibility of trillion-dollar companies. Well, Apple has now surpassed $2 trillion valuation, and Microsoft and Amazon are following not far behind at 1.6 trillion valuation each. We also see in the venture and growth private landscape, lots of activity, fantastic growth in many areas, and some of the sectors that the guys will comment on here later today are truly going through incredible transformation. We are, of course, cautious around valuations. I mean, it's tremendous to see this level of interest for our industry, but we're going to see also a lot of volatility ahead. But in that, I think you need the kind of stable thinking and long-term thinking that we'll be sharing here today and that we've been sharing for the last 20 years. So with that, back to you, Alec.
Thanks, Per. That's really helpful. I think it sets the stage for today's discussion. Just a reminder to all participants to submit your questions. Just use the Q&A box at the bottom of Zoom, and we will address those at the end. With that, let's get started. Let's look at what we predicted in our previous report. So we like to do this every year. It's kind of a grading sheet on how we fared on our previous predictions. So the recap of 2020. Our first prediction was that the war in streaming film and video is escalating to a frenzy. This one we absolutely picked correctly. Streaming and film and video took off in much larger ways than we could have ever predicted. New streaming services from the likes of Disney, Apple, HBO, ESPN, and Peacock really took off. Our second prediction was that relational databases make way for data lakes. Our prediction was that data lakes would start replacing relational databases. This was partially correct, but also partially incorrect. While data lakes are clearly demonstrating supremacy over relational databases and other legacy products, relational databases will remain an important component for organizations in the foreseeable future. Our third prediction was that companies are turning to verticalized AI solutions to solve real business challenges. This trend proved correct in 2020 as businesses broadly continued to struggle with their enterprise-wide AI strategies. It's clear that in 2020, verticalized point solutions or AI integrated into vendor software are proving most impactful. Our fourth prediction was that AI and ML is showing quantifiable results in marketing. This trend was picked correctly with the massive jump in online behavior and e-commerce this year, growth in companies like Brandwatch, Talkwalker, as well as Sprinklr's $200 million raise is a testament to the demand for AI-powered products that automate marketing efforts and provide customer analytics. Our fifth prediction was that Apple's A13 Bionic sets the precedent for on-device AI and machine learning technology. The A13 Bionic chip marked an unprecedented incremental leap in on-device mobile compute capability. Our prediction proved true, considering Apple followed up with an even more powerful A14 Bionic. Also, Samsung, Huawei, Qualcomm all followed this year with the release of their own advanced chipsets. In the gaming space, prediction 6 was that gaming embraces the era of subscription and streaming. This trend was picked correctly, also benefited from a sharp rise in COVID-driven gameplay. PlayStation Plus subscribers exceeded 50 million, up from 40 million at the same time last year. Xbox Game Pass has over 15 million subscribers now, representing a more than 50% jump this year. Our 7th prediction was that corporate social responsibility takes center stage. This was also correct. CSR is being demanded by customers of both B2B and B2C brands. The more socially responsible the company, the more supportive the community and consumers become. And as mentioned previously in some of our transactions for 2020, we closed a transaction for EcoVadis. We raised $200 million. They're a leader in software-driven CSR ratings. We saw significant investor interest in that process. Our 8th prediction was that 5G land grab, the race for commercial deployment of 5G. We picked this trend correctly as the massive rollout of 5G has increased dramatically this year, with more and more devices enabled for it. Network providers are also expanding their 5G capabilities, and US, South Korea, and China are leading the global landscape in adoption of 5G. Our 9th prediction was the edge of tomorrow. We were correct with this trend as connected devices are now generating more data than ever before. Large players such as Google Cloud have increased their bets on edge computing. This year, Google partnered with 200 developers to make edge computing possible in parallel with the rollout of 5G technologies. And Red Hat has also recently built native edge computing features into their software. And our last pick for 2020 was everything as a service. This was also correct as the shift to as a service models continues to increase. Dell recently announced it's moving all of its products to as a service models, and we've seen a huge rise in consumer subscription software and apps, which has led to the rise of healthcare as a service, fitness as a service, communications as a service, among many others. So that's a quick wrap of the 2020 predictions. With that, I'd like to pass it over to Brandon Overmyer to take us through our first few predictions for 2021.
Thanks, Alec. Yes, my name is Brandon Overmyer. I'm a vice president with GP Bullhound. Very excited to be here with you today to share some of our really exciting 2021 predictions. So the first one, I think, is very obvious to many of us joining via Zoom here today rather than at a large venue with a stage. For many of us, the pandemic has really forced a significant change in how we work and collaborate. And for plenty of people, it's worked out quite well. They're more productive and satisfied, with their new remote lives. But for others, it presents a lot of challenges: poor connectivity, lack of personal space. Children, have really challenged the concept of the home office. Video chat has also been around for many, many years, including Zoom. But now we've seen it become, the real default instead of, what would have otherwise been done over a phone call. And, we have a bunch of other collaboration tools, Microsoft Teams, Slack, which now is a part of Salesforce. They're really being pushed to their limits. And so, there's a lot of attention going into this space to really, make remote work and collaboration more viable. Before the pandemic, about 30% of people in remote viable jobs, ever even worked remotely, and in just a few short months, that's well north of 50% now. And that same number, even more, actually expect that they'll continue working remotely post-pandemic, either for some or all of the time. And it really brings us to there's this new buzzword that's floating around Silicon Valley, and we think of it's the hybrid workplace. Large tech companies, Facebook, Google, Twitter, really proving that these models can be successful long term and have changed, some of their current work policies, with many announcing that employees can work from home indefinitely. So, things like productivity can increase, greatly, depending on the situation. Work-life balance generally improves. And, one really interesting anecdote here, Dropbox, for example, which is headquartered in the US, they certainly had European operations. And, previously, the European base would feel a bit removed from the team because, everybody's in an office and they're on a Zoom screen. Well, now it's sort of become the great equalizer, and it's it bridged the continental divide. And so we see some really interesting things coming out of this. It's hard to say what the sort of the return will actually look like, but we certainly expect companies to adopt more hybrid and remote models, and really an increased reliance on communication and collaboration tools. Some interesting companies in this space, aside from the ones I mentioned, Glue, Confluence, Klaxoon, Asana, all doing really exciting things in this space. Moving on to the second trend, one of the really interesting things here with in terms of healthcare, we think obviously we're in a health-related pandemic that is hopefully ending soon. But it's really quite interesting that it took this to kind of alter our fundamental behavior, and it almost took us backward in certain ways in a positive way. We've effectively brought back the house call of yesteryear, of the bygone era, where the doctor would visit you at your home. And now we have telemedicine, where you can virtually and on demand visit your doctor at the comfort of your own home, and even share photos, videos of whatever might help in sort of a diagnosis. So instead of going to a dermatologist to get a non-urgent annual skin check, you can now show the doctor what might concern you over photo or video. In terms of the market, it's increasing immensely. So we almost a 40% increase, or 40% CAGR over the coming 5 years in terms of telehealth. And there's been a ton of anecdotal evidence where we have urgent virtual visits and non-urgent virtual visits increasing by 7x and 43x, in just a very short time. And that's an interesting stat out of the Northeast of the United States. And obviously the downloads of these types of apps that facilitate this have skyrocketed. And one other really interesting thing here, when you think about access to healthcare and infrastructure, one of the great things that this is doing is really democratizing access to historically underserved areas, which might not have the right healthcare infrastructure. And if you look at sort of regular, continuous care, if you're in rural areas, it's been a challenge if you just had a sort of a simple doctor visit that you wanted to take care of, and now you're able to do much of that remotely. So we expect many of these changes to stick over the long haul, and importantly increasing access to healthcare. Some interesting companies here: Babylon Health, Health Hero, MeMD, Teladoc. Moving on to trend 3. This one's kind of twofold. So despite the sort of GDP concerns, macroeconomic challenges that were kind of early on when everything was much more unknown, we've witnessed in just a matter of months the e-commerce market accelerating effectively by 4 to 6 years. US online retail sales saw a significant jump between Q1 and Q2 in spite of some of those uncertainties, and we're seeing new demographics that are leveraging e-commerce either by the forcing function or by an increased sort of clamoring for more convenience. Even countries with very little e-commerce pre-pandemic, such as Italy, have seen the adoption rapidly accelerate. And PwC published an interesting report. 28% of European consumers had used online shopping as the main channel of buying their groceries during lockdown, which in just a short period of time was a more than 10% increase to pre-pandemic levels. And another interesting, kind of trend along with this is, we've had just a number of years now where we can expect 2-day delivery for many items. And what we're seeing in sort of our collective societal Veruca Salt, I want it now moment, is that customers want that instant gratification, or consumers want that instant gratification. And so this growth of what we call buy online, pick up in store, or curbside pickup has skyrocketed. It's gone, in certain areas close to 300%. One of the companies we interviewed, one of the CEOs, Equid, they saw their buy online, pick up in store growth go up by north of 400%. And in the US, you have 3/4 of the major retailers in the US now offering this curbside pickup. such as Target and Best Buy and Walmart. Some interesting companies here, as I mentioned, we interviewed Equid for this report. DoorDash has been mentioned, Shopify, Amazon, but really an exciting trend for us to highlight this year. Moving on to trend 4, thinking about how brands continue to differentiate themselves. Customer experience is increasingly critical for companies to best succeed and deliver the real personalized experiences that differentiate them from just their products. So you can think of customer experience and understanding the customer as part of the product now. And so we've historically seen companies, have a marketing technology stack and maybe a separate customer experience tool and survey, et cetera. And what we're seeing is that companies are really retooling their stack to get a more complete picture of the customer. So there's a really big increase in the reliance on customer data platforms. We see the tangible results too. Companies that classify themselves as very advanced in terms of customer experience tend to have a significantly higher probability of reaching their own profit goals. And if you think about where customer data, customer experience, and the MarTech stack go, they really are starting to converge together. Many of the major marketing experience cloud vendors such as Adobe, Oracle, Salesforce, SAP, all released consumer data platforms this year. In the market, we expect to reach in excess of 10 billion over the next 5 years. So we expect all of this to continue, but the key here is that we're seeing quite a bit of consolidation in the space. Bringing CX, integrating it into the stack, not having silos, really understanding that customer journey from end to end, and really differentiating yourself as a brand just beyond the products that you offer. Some interesting companies here: Appier, Uberflip, Customer Thermometer, Newstar, Salsify. All should be on your radar for looking into 2021. And moving on to trend 5, we were just talking about how the customer journey is really important, and what we're likewise seeing is sort of a shift in customer sentiment, even more toward understanding what kind of data is out there on me, and understanding what can I do to sort of control my privacy. And so we're seeing an ever increasing rise, obviously in mobile phone usage, consumer subscription, software and services, and we're beginning to see kind of the pendulum swing back. Obviously, we've had the GDPR, which kind of led the way in terms of data privacy, the CCPA in the US, and everybody on this has probably seen some ever more frighteningly targeted ads on Instagram, Facebook, Google, and others. So one of the things the privacy regulations have done is they've taken a step in the right direction to require explicit consent to obtain your data. And now we're seeing more clarity as to what type of data brands and companies are collecting. But in spite of this, we still see fines being levied against Google and Facebook, for example. So we still have a long way to go. But many companies are actually looking to now differentiate themselves on sort of being privacy first. So obviously, one of the big conflicts in terms of what we just talked about is the difference in, we have personalization, convenience, offers, loyalty. This data is used for a purpose. It's to enhance your experience. However, it's an inherent conflict. We want more personalization or more privacy. So you're seeing brands like Apple and Google, Apple in particular in iOS 14. It's not yet released, but your users are going to be able to opt out of app tracking in iOS 14. And just yesterday, they added privacy labels to the App Store, which show a particular app what kind of data that they're actually soliciting from you and that they're going to get. So it's really, I think, a win for the user, yet still allows for us to continue to push on getting a more personalized experience. Some interesting companies here: 4iQ, Brave, which is a privacy-focused browser; DuckDuckGo, which is a privacy-focused search engine; OneTrust, and TrustArc. And with that, I'll pass it over to Eric to take us through a couple more.
Great, thanks, Brandon. So moving on to trend 6, survival of the fittest. So as many people have noticed, connected fitness has had a boom year, with consumer adoption accelerating due to COVID and a loss of traditional gyms in many places around the world really accelerating this trend. However, many people are asking if this is a one-year bump and people will return to gyms in large groups in the future. However, our research shows that connected fitness has been growing pretty consistently over the last 5 years, primarily driven by companies integrating sensors and social features into their products to enhance our workouts and our outdoor fitness. So this allows connected fitness to not just be a replacement, but truly an improvement over past gym experiences. And so the consumer adoption is obviously swelling these businesses' financial story, and investors are taking note. So we've seen Swift raise a large round from KKR. Strava just raised a $200 million investment from TCV. And one of my favorite companies, Surfline, just partnered with the Sheridan Group to really expand their consumer subscription offering. So overall, I think this space will continue to be hot. It will not be a one-time bump and kind of revert back to normal, but more of this is going to be how we're going to work out and get fit in the future. So we expect to see many more deals as the industry matures, and it continues to attract new users looking for a better fitness experience. So excited to see what 2021 and future years have for this category. So let's move on to trend number 7. So cash is no longer king. I'm sure many of people on this webinar have been long using financial tools, including PayPal and Venmo, probably adopting Apple Pay, Google Pay, and maybe even Cash App over the last couple months, or they've been using these for the last couple of years, but the majority of consumers have really started adopting these heavily over the last year. So in Asia, for example, digital payments have long been dominant, but it's been much slower here in the US for these to take hold. But over the last 9 months, both businesses and governments have been rapidly promoting these experiences for consumers to reduce not only physical cash, but also improve the ability to be taxed, as cash is harder to track for governments in maintaining accurate tax records. So recent news in this space has been really exciting. One of the things that I'm most excited about is the Stripe Shopify partnership, where Stripe is launching a banking as a service product called Stripe Treasury, as well as Stripe Capital. And these two new Stripe integrations will allow Shopify, which is one of the leading merchant providers out there, to offer its e-commerce consumers immediate access to a bank account for the business. So, this space is continuing to innovate. Large banks no longer have a hold on their consumers by using their physical stores or their physical branches, and consumers are rapidly adopting new tools that integrate quickly across a variety of their services, both on wealth tech as well as just their day-to-day spending. And so we expect to see many more types of these partnerships launch over the next 12 to 18 months and continue to drive innovation in the banking and finance sector. So with that, I'll turn it over to Alec to cover trend number 8.
Thanks, Eric. So trend 8 is education in the 21st century. With COVID, remote or distance learning has become the new normal for much of the world. 90% of countries have implemented remote learning policies due to the pandemic. I live in California, and I can attest to this, as all 3 of my children have been 100% remote learning since mid-March. And we don't expect that to change for the foreseeable future. While e-learning was already gaining momentum, I think this trend has been accelerated by 5 to 10 years due to COVID. And as a result, the education technology market is now expected to grow at a compound annual growth rate of 18% from 2020 to 2027. And while e-learning usage has increased, so has funding. There's been a massive influx of capital into the space. $8.3 billion was invested into ed tech globally in the first 3 quarters of 2020. On the application side, Google Classroom and Seesaw have been some of the most used online platforms for schools. For math skills, Prodigy, Reflex, and Khan Academy are popular. For reading, ABC Mouse, Epic, and Vooks are leaders. Language learning, Busuu, Babbel, Rosetta Stone are some of the notable names there. Now that online education market has shifted, we don't see it ever going back. We believe future learning will be some hybrid of online and in-classroom learning. Moving to trend 9, the next social network. piggybacking off a separate report we published on this topic in November of this year, our thesis is that we're beginning to see online games migrating towards social networks. For those that have kids, I'm sure you're acutely aware of the ways this next generation plays games. They sit in the same room or separate rooms or homes and play games like Fortnite and Roblox concurrently the entire time. They're either communicating through the game itself or through mobile phones. So it's a very social experience. There's a few main contributing factors driving this trend. First, the adoption of mobile phones. Now you have a gaming device in your hand and accessible all of the time. Secondly, in-game communication is now the best it's ever been. Players can easily talk in real time. And business model innovation with the prevalence of free-to-play has created lower barriers to entry. And then lastly, cross-platform technologies, new games like Fortnite, you can access the same game through any device, console, PC, mobile phone, tablet, which improves the accessibility and the social features available. So we believe games will become the social networks of the future for the younger generation. And we're already seeing this happen now. So the last trend for 2021 is Epic's Ultimate Battle Royale with Apple. This is a trend that we've been tracking for a number of years. We originally wrote about it 2 years ago. Apple and Google were starting to see even then a backlash from developers who were fed up with their commission fees. For those who may not be as familiar with the issue, Apple and Google have strangleholds on mobile app distribution through the App Store and Google Play stores. Over 99% of mobile devices use either Apple's iOS or Google's Android operating system, and all of those users download mobile apps through their respective app stores. Historically, Apple and Google have charged 30% commissions in year one and 15% commissions in subsequent years to developers. And this trend with Epic really came to a head this year in mid-August when Epic introduced a new direct payment system into Fortnite, which bypassed the App Store and the requisite commission. Apple retaliated by kicking Fortnite off the App Store, and Epic responded by filing a civil lawsuit against Apple, alleging they broke antitrust laws. Concurrent with that lawsuit, Epic also launched a bold viral PR campaign. I'm sure a lot of you have seen it. They basically flipped Apple's original 1984 Macintosh commercial portraying IBM as the evil big brother on its head. The new video shows Epic as the revolutionary against Apple as the evil big brother. And what made this action so credible was that Epic and Fortnite were one of the only, if not the only developer that had enough scale and consumer following to credibly fight Apple. Shortly after, a number of other app developers lined up behind Epic, Match, Spotify, and Deezer, to name a few. And consumer sentiment has continued to build against Apple. Last month, they announced a reduced commission of 15%, but only for developers earning less than $1 million per year. So we believe Apple and Google's one-size-fits-all commission structure will need to further change, and we expect to see more announcements around that in 2021. So that concludes the presentation portion of the webinar. Now let's move to Q&A. I think we've got a number of questions that have been submitted into the systems. Maybe why don't we start with a few? Looks like the first one, this is, I guess, on telemedicine. Does GP Bullhound anticipate that telehealth will come to replace the introductory call between patients and physicians? Maybe Brandon, you wanna cover this one?
Yeah, happy to. This is a particularly exciting area for me, and as I had mentioned earlier, obviously there's an increase. We kind of faced a forcing function here, and the technology, frankly, hasn't quite caught up in terms of remote diagnostic tools, et cetera. When obviously when you go to the doctor, there's an exam room. So if you don't have an exam room at your home, it's really difficult to replace all types of in-person visits. But the trend seems to indicate that more and more are relying on this. And there's, there's this notion, we interviewed actually a couple of doctors for the report as well. And one of the things that we found was there's a new initiative on sort of sending out sort of care boxes, if you will, that have maybe a stethoscope or other types of diagnostic tools that can be used in conjunction with virtual visits. And the other interesting thing too, if you think about the benefit for physicians, they're able to see 50 to 100 times the number of patients via telehealth before the pandemic. And so, we really expect this to continue, but there's quite a bit more of technological development we need to do around remote diagnostics and peripherals.
That's great. Thanks, Brandon. So we got another one here. Looks like on the connected fitness space. What does the competitive landscape look like with big players such as Apple creating their own apps within devices like the Apple Watch for mental or physical fitness? How do these compete with niche players like Calm or Headspace? Maybe Eric, do you wanna cover this one?
Yeah, I think this is a big question that a lot of people are wrestling with in the sector, and I would kind of compare it to big brands across any other categories. Is there's always going to be people that are going to adopt some of the big brands, but the great thing about this sector is that it can truly focus on a niche and provide something for people that are looking for something very specific to their workout goals. There's workout apps for weight loss. There's workout apps for heavy lifting. There's workout apps focused on flexibility or endurance. And so it's hard to do a one size fit all in this category. And while Apple's offering is fantastic, my personal view is it really just validates the demand in the sector and is not by any means a category killer. So I think the space will continue to really thrive and grow. And Apple's entry into it is really just a validation of the valuation here in the sector, the opportunity.
Thanks, Eric. Let's see. Looks like an education related question. In the future, how will public and private schools be impacted by recent trends in remote learning and online education? Maybe I can tackle this one. I don't think we're ever going to go fully back to the way things were pre-COVID. When you think about private versus public schools, private schools have more flexibility in approach versus public schools. They're not as regimented or regulated with curriculums. They have more resources, et cetera. And clearly public schools are more restricted in these areas with far fewer resources. I think it's also clear that fully remote schooling is suboptimal though. And I saw a statistic, I think it was, they did a survey of teachers in the United States, and on average, only 60% of students are engaged in remote learning on a regular basis. And there are pretty wide gaps in perceived engagement along racial and socioeconomic lines. So we believe a more integrated hybrid approach with classroom-based learning bolstered with robust e-learning is the most likely model of the future with schools. And I also think that parents will continue to utilize ad hoc supplementary e-learning apps and modules to bolster kind of a particular area of need or interest for their child or their student. So we've got a question on e-commerce. Will some e-commerce native brands come to embrace a hybrid approach that utilizes brick and mortar locations in order to take advantage of booming demand for curbside pickup?
Yeah,
Brandon,
I can take that one. Yeah. I think we can look no further than Amazon in this case. So just as Amazon sort of put brick and mortar bookstores out of business, just a few years ago, they started buying brick and mortar bookstores. And you can look at their Whole Foods acquisition as well, as sort of a brick and mortar presence. And I think it's really interesting to see when you think about the brick and mortar presence as it relates to what we were talking about with buy online, pick up in store, local fulfillment, local delivery. So, I do think the hybrid approach is absolutely here to stay. And some of it has to do with, as I mentioned earlier, our desire to want things now and in the most convenient way. So right now, where we have 2-day delivery as sort of the norm, Amazon you can already get things that are delivered in a couple of hours. So we expect that to increase, as well as sort of an increased reliance on, sort of the pendulum is swinging back the other way in terms of actual physical presence for convenience.
Great. We've got a question on payments. Is a full cashless society possible given the concerns that some have expressed in areas such as San Francisco that cashless commerce marginalizes lower income communities? Eric, do you want to cover that one?
Yeah, I think it's a really interesting and challenging question. And it's both consumer dynamics as well as political dynamics that are coming into play here. I think the interesting thing you're seeing, and let's just use San Francisco as an example, is restaurants, stores, venues that typically work with a tech-enabled clientele will probably take the majority of their transactions cashless, and so would prefer not to touch cash at all. Now, there's other stores and restaurants that are in disadvantaged communities, or people that are maybe adverse to using mobile phones will continue to use cash because that's what their customers continue to use. And so what I ultimately think happens is it will come down to where the businesses are located as far as will they accept cash or not. And so, I think you end up as with cash continuing to take over, or excuse me, digital continuing to take over a bigger and bigger portion of transactions, but there will be pockets of consumers and geographies that will continue to use cash really out of preference. So I don't think it's probably going to be 100% anytime soon.
I think it's just worth adding to that the country in the world that is the farthest ahead in forms of less use of physical cash is the Nordic country, Sweden. And one of the reasons that they could propel ahead was they built an app at no cost to the consumer. So today, even homeless people will take what's called Swish, and you can literally go to a homeless person and make a digital transfer. So I agree with you, Eric, that before it's across 7 billion people in the world, that will take a long time. But I think there's definitely technology innovation already made that makes it possible to touch everybody in society in a local economy.
And just, I guess, looking through the Q&A box here, we have some great questions. Probably won't be able to get to them all, but here's an interesting one. Which streaming service do you believe will ultimately be the champion? And do you see much more consolidation in the industry in the future?
Maybe I can take that one. I mean, I think it's Netflix. That's my personal view, and maybe that's a U.S. centric view, but I think that Netflix has aggressively expanded, globally in the past few years. It's the fastest growing region, outside of the United States. International is their fastest growing area. So I think in video, Netflix will is the winner and will retain that. I think in music, it's Spotify. I think that's become pretty clear over the last few years. It's been interesting to see this kind of bifurcation. I think more on the kind of the video streaming side with, launching, Disney Plus and Peacock and ESPN Plus and a host of these other, streaming services. I think what we're seeing is, and we wrote about this in one of our predictions report many years ago, but the unbundling of the cable package. And I think that's this is I think proof of that happening. And, if you look at many millennials or people in their 20s now, most don't even have cable subscriptions. I mean, they're just having OTT subscriptions, that they can select a la carte from a menu. And so, you'll have maybe your HBO, you'll have your Netflix. So I think that once kind of the initial momentum and kind of, the streaming area, starts to simmer down a little bit, I do think you're going to see some consolidation with the players that maybe didn't make it into that top tier. I think you'll probably start to see some consolidation there.
And then maybe worth mentioning, even though it's not streaming in the traditional sense, is the enormous growth of YouTube and TV length content on YouTube, and then short form streamed content on TikTok is not to be underestimated either.
I have another question. How much do you think the adoption of Microsoft Teams compared to Slack is by virtue of it being included in the Microsoft Office 365 bundle? And do you think the acquisition, of Slack by Salesforce may help to level the playing field? I'm happy to kick this one off. I think it's a very astute observation. If you look at the chart that we have around that trend with the Slack and Teams adoption, Teams shot way past Slack. I mean, many companies were already using Slack and they had to choose to use it. But given it's included as part of the predominant Office productivity suite, a lot of companies just had the simple task of turning it on. And I do think, in regards to how that, parlays into Salesforce's acquisition of Slack, Salesforce is the largest CRM provider in the world. So it's going to offer at least the capability to have a similar sort of turn on the switch functionality. One more question here. We didn't note specifically in our 2021 trends, a trend around sustainability and corporate social responsibility. And how do we think that will impact and affect areas across the predictions we've made? So we featured this front and center last year and covered it in the recap earlier. But I do think it continues to be, incredibly important as more consumers are conscious of where their products and services are coming from and how they're made. This will continue to be a bigger and bigger deal. So while we predicted it last year, we've seen a lot of it this year, but that's going to continue for many years to come.
I mean, it's also worth to mention that we see a lot of CSR initiatives across our client base and portfolio companies, whereas I would say I think impact did take a bit of a backseat due to COVID. And I would forecast a lot more media attention on impact once we're past COVID in May or so.
Got one more question here. Maybe Eric, if you want to take this. So thinking about food tech, is delivery, delivery from restaurants, is that really hype for COVID times, or does it really have a chance of being a continued change behavior post-pandemic?
Yeah, I mean, I think you get a lot of questions like this as consumers are adopting new, getting into new patterns, new hobbies, new habits due to COVID. So my gut says, I mean, delivery of food is substantially easier, especially for families, where before I think it was primarily adopted by individuals living in large cities. I think, as you can see, the success of the DoorDash IPO was really driven by, the suburban food delivery people, or food people ordering food in suburbs here in the U.S. And so I think that trend will very much continue. I think if you look at other countries, to get away from a U.S. centric view, specifically Asia, food delivery is very big over there. There's public companies that are much larger than what we have here in the U.S., like Uber Eats or Grubhub, that have been doing very well, and because it ultimately offers a better consumer experience, especially in large cities. And so I think this will be a trend that continues for quite some time. But you'll probably see some continued innovation. You'll also see a decent amount of consolidation with probably ultimately one or two major players per geographic location, because scale does matter here. But great question.
Thanks, Eric. And we'll do one more. So we do get questions like this every year. Why is there no prediction specifically related to AI and ML this year? So maybe I'll kick it off, but I'd love to get all the panelists' input on this. And I think the real answer here is because it's evolved from sort of a check the box to a really sort of permeating just about everything that we do. Now your iPhone has AI and ML capabilities on it. and thinking about how it's relating to customer experience. It really does weave through many of the trends, and I think it doesn't thinking of it on a standalone basis. Hey, we're an AI tool. Everything is going to need to be AI and ML powered.
Yeah, and it's funny, Brandon, you mentioned that, because actually I remember when we were drafting the predictions for last year, we had AI and ML were kind of woven into like over half of the predictions, and it felt a little strange, but actually, that it shouldn't, because these technologies are becoming pervasive across the technology landscape and in almost every prediction that we're going to be make in the future.
I mean, it's the natural evolution of software. I mean, the first attempts at machine learning was developed in the 1960s. They were pretty raw back then, and we've seen tremendous improvements due to the compute available to us. And it keeps on accelerating, but it's too general, I think, to be in our trend report. But Brandon, there was also a question about breaking up big tech. Do we want to cover that?
Sure. Let me see if I can. Yes. How do you view sort of changes which could impact regulation of big tech going into 2021? For example, Facebook antitrust. Per, do you want to kick that off?
Yeah, well, I think the most important thing to recognize is that for most of these companies, the sum of the part is much greater than the value of the whole. So breaking up these companies is not necessarily bad news for share owners. I mean, you effectively get what's up for free now inside Facebook, Instagram, and just imagine the idea of breaking up Microsoft into its component products. If you look at what enterprise SaaS software is worth today, it would be fantastic. I think the reality is these companies are very hard to break up, and this is the kind of political drum talk we've seen in our industry for a long time. I don't think we will see much of it. I think the only company that really could be under serious pressure is ultimately Amazon, with both the AWS business hosting all other e-commerce and then being their own. But again, net as an Amazon share owner, which we are through our funds, that would not necessarily be bad news.
Yeah, and I would also add, I think there's some level of benefit by companies sort of endeavoring to do this on their own. You can look at the Qualtrics spin out, for example, and that really is to allow kind of separate innovation focuses. At some point, a company is so big, as Per had mentioned, you have Amazon, which is essentially functions as a marketplace, and then you have it's also the backbone of app development and cloud services. And so to really be able to sort of focus on those two and give them the attention they need, I think you'll see quite a bit more activity in this regard.
Well, I'm afraid with that, we've reached the end of today's webinar. We're out of time, and as promised, we've kept it to an hour. As a reminder, you can download the Tech Predictions report by scanning the QR code here on the right-hand slide. And then you could also go to gpbullhound.com insights to do that as well. So thank you to all for joining us today. We hope that you all leave with some new ideas and insights, and look forward to welcoming you all again soon. Have a great day.